Thank you for having me. I relish the opportunity to learn from you all and to share what little knowledge I've accumulated. I'm going to talk about financial products in the U.S. power markets. As we talk about renewables, by the way, this is not a presentation on project financing. It's about financial products and hedging exposure in shorter terms. So think about a year, a month, a week, a day, an hour, 5 minutes. Before I begin, I'd like to say that the views in this presentation are my own and do not reflect those of the Federal Energy Regulatory Commission, its commissioners, or its staff. So I'm going to go over a brief overview of the US wholesale power markets. Then I'm going to talk about what types of participants we have. I know we're now in the 25th year of deregulation, so the mix of market participants in the US is going to be very different than in India. That being said, you'll see the incentives and the hedging needs are actually not dissimilar. Then I'll go through the hedging products available and financial markets. And finally, I'll talk about the regulatory framework around monitoring and making sure these financial markets interact with physical markets in a good way. So US wholesale markets, there's two sort of market design constructs. One is the organized wholesale markets, the RTO, ISOs. RTO is regional transmission operator. ISO is independent system operator. It's used interchangeably. They're the same thing. They're centralized markets. If you look at the East Coast, the Northeast, the Midwest, and California, they're organized markets, centralized. And then there's two broad regions in the US, the non-RTO West, and then the Southeast that are still bilateral markets, or non-RTO markets, we call them. What is an RTO ISO? I could spend 3 weeks talking about that. I'm not going to. It's an organized wholesale market that's centralized. It's regional. It's one independent nonprofit operator that sort of aggregates generator bids, load bids, that operates the full transmission system. It's open access, meaning the local utilities have to turn over their entire transmission system grid to the operator. It's an economic model. It's also a dispatch algorithm. It's all combined in a nodal system. So each generator bus, each transformer, each substation, each load node will be one particular node. That node will have a price associated with it. It's a single price auction at the nodal level, meaning everyone submits bids at a certain time. The RTO will solve for least cost dispatch with constraints, of course, of thermal limits, reliability, frequency, blah, blah, blah. It then produces schedules that are financially binding, and then the RTO ISO will then give you dispatch signals. Let's see, I'm gonna try to go a little bit faster. Non-RTO, it's probably, so the Southeast region and the Western region outside of California are more analogous to the Indian market. It's a patchwork of balancing authorities, mostly vertically integrated utilities. The training's long-term, a lot of base load. There's a few spot transactions, no visibility, no real market prices, no exchanges per se. Okay, so who do we have in the US in terms of types of participants? We have physical asset owners and load-serving entities. Those are your vertically integrated utilities. Both public and private investor-owned utilities. And then you have your independent power producers, or IPP, and merchant generations. Those are just private companies that own generation assets and are trying to maximize that portfolio. The second type is speculators. Those are proprietary traders and hedge funds. Those are purely financial market participants that take a certain view on wholesale power prices and make financial bets or physical trades based on that short or long-term view. Your third category is what I call liquidity traders. Those are usually market makers and big financial institutions with large capital and cash reserves that will not take bets per se, but they'll be the intermediary between the physical players trying to hedge risk. So what they'll do is they'll be both on the buy and the sell side and take on spot risk. And those are sort of your linchpin of the financial markets we'll be talking about later. Okay, I'm going to blow through these. So Berkeley and utilities, which is probably what India has the most of, they have generating assets, and the revenue is going to be the spot price. The cost is going to be your fuel price for thermal units and capital O&M for both thermal and renewable. So your exposure, when I'm going to talk about financial markets, I'm going to talk about hedging exposure. It's going to be spot price, so you're long the spot price, you benefit from higher power prices. When we short the fuel price, you benefit from lower coal prices, lower gas prices. On the load side of utility, you're making your fixed retail price, so that's not an exposure, that's just a fixed price negotiated whatever annually. But then on the cost side, you have your wholesale market spot price exposure. On this side, you're short, meaning you benefit from lower prices. And finally, you have transmission assets. In the US, most transmission is rate of return based, meaning it's cost of service. It's not an exposure to spot prices. So your costs are really the O&M of building transmission. It's a little more complicated than that, but I'm not going to talk about that. So what do you need to hedge all those risks? You have risk of fuel price, you have risk of net load. If your generation asset portfolio is smaller than the load that you serve every day, then that load, you have imbalanced load. If your spot load that materializes during the day, during the real time, is higher than your forecast load or your forward procured load, it's a risk. There's non-performance that's very relevant for renewable asset generators in the US, and when your spot output is less than your forward obligation. So that could be the wind blowing less, the sun went down a little bit earlier. It could be on the thermal side, your plant tripped, and all of a sudden you owe the grid 100 megawatts, and you can only provide 30. And so all of those I'll call spot price risk, which is now I'm coming into short-term market, and I'm short, and I got to buy power, or I'm selling power, and I'm exposed to that price. The second risk is congestion, which is more of a locational or like basis risk called in financial markets, which is I built generation in a certain area, I have load in another area, a city, and it's going to be pricing differences. This is a very heightened risk in RTO ISOs, so centralized market, which is nodal. Your generator are always going to be in nodes that are far away and with lower prices than your load's going to be in zones that have higher prices. And that difference is called congestion, and that congestion could drive energy revenues. Okay, so that's vertically into utilities. The next is independent power producers. So those are just companies that own power plants that are not attached to any native load or load. They face similar risk, except they don't have the whole load side of it. I won't go over it. But a non-performance forecast error is one of the big ones. It's when you have a forward obligation and then you can't meet that due to either forecast error or plant trips. Okay, The third category is financial players, speculators and liquidity traders. Those are companies that hold portfolios of both physical access, so physical power, or the underlying sort of heat rate, underlying commodities like gas and coal, and then a whole portfolio of financial products. And they're trying to just optimize that. The entire point is they're going to be paid rents to take on the risk of the physical players, the vertically integrated utilities and the merchant independent generators. They could either take bets and be on the other side. If a merchant generator is naturally long the spot price, a financial player might take a short position. The fixed price negotiated for that short position is going to be at a price that's advantageous, that has a premium over what the actual merchant generator could do with its own sort of balance sheet. Okay, what's available? Well, before we talk about the financial products, we could talk about the physical products. So PPAs are very important. I'm sure everyone here knows a lot of PPAs. In the sort of organized market construct, a PPA could be considered a physical contract. It could also be considered a financial contract. If your physical requirements are through the grid operator, and you're exposed to short-term forward day-ahead risk, or actually real-time spot risk, a PPA is essentially a financial future between you and some counterparty. It doesn't really matter that it's a load-serving entity or a generator, it's a purely financial contract. You could view it the other way in non-RTO markets too. And then there's tolling agreements. That's a way to completely offload both the spot price risk and the underlying fuel risk by just contracting with a counterparty where if you're the generation asset owner, you could just be paid a fixed fee to operate your plant while the buyer takes on both the underlying commodity risk and the power price risk. The second portion I'm talking about is financial derivatives, which are future swaps. And then there's a battery of financial products that are just available through the RTO ISOs in organized markets. I'll talk about that. Okay, PPA, I'm not going to define that. That's pretty easy. You have your asset owner. They receive a PPA fixed price from a buyer. In return, they provide electricity. PPAs throughout your ISOs are a little bit more complicated because the generation asset owner still has to go through the central auction and sell its power to the grid operator, and the grid operator then sells that power to load-serving entities. So the asset operator is still exposed to the spot price through the auction and provides power to the RTO, and then the load buyer will just pay the spot price to the RTO and get the power, and then completely outside of the construct of the operator and the RTO, a bilateral PPA between two entities will be for a fixed price versus spot price. So this is why PPAs and RTOs are very analogous to purely financial contracts. You know, they're not considered financial in terms of regulation. Tolling, it's a way to completely offload any sort of price risk. You built a power plant, you're now being paid to just operate the power plant, and someone else takes everything. Okay, financial futures swaps. What is a future? A future is a financially settled derivative contract tied to an underlying physical commodity price during a specific time frame. So usually they're what we call fixed for floating, meaning if I'm the buyer, I will pay you a fixed price per megawatt hour, whatever it is, per kilowatt month, and then you then pay me the floating price. The floating price is usually tied to an index. It's sort of a market outcome of spot prices yet to come. Of course, there's floating for floating, where you could also take a bet on two index prices. And cross commodities, so spark spread is when you take the difference between the power price, the gas price. There's heat rates. There's weather derivatives, based on cooling degree days, heating degree days. But mostly the futures and swaps that are traded in the US power markets are fixed for floating. Futures and swaps are the same thing. The only difference is regulatory-wise. So futures are typically traded on an exchange and have standardized terms. Standardized, so megawatt quantities, lots, standardized date ranges, standardized where the underlying index will actually come from. Swaps are the same principle, fixed for floating, but it's bespoke negotiated contracts between two different entities. And those are typically traded bilaterally through either brokers or large banks. And then options is just a different flavor of futures and swaps. So it's fairly simple. If you're a buyer of a future, you're long. You benefit from the price going up. If you're a seller, you're short. You benefit from the price going down. You negotiate a fixed price up front. If you consummate the trade, then you got to wait until the time period happens, and you calculate what the average price is, the floating price is during that time period, and it's purely financially settled. It's completely outside of the actual physical markets and does not impact the actual spot price of power. Okay, the RTOs have a whole suite. If you think about the nodal construct of an RTO, especially that basis risk, locational risk. Now you have a portfolio of generators that are at certain nodes with marginal prices associated with them, and you have a load portfolio at zones, and they have different prices. Hedging that price difference is very important. That price difference happens every hour of every day. So the RTOs have come up with this product called FTRs that will, I'll skip ahead, gives the owner of the FTR the right to collect the price difference between a source node and a SIC node over some time period. So that allows vertically utilities to perfectly actually hedge their portfolio, their balanced portfolios. It also allows financial players to take bets on congestion. The difference between this and the futures and the swaps trading in financial markets is the RTO is the counterparty on everyone, meaning if you go to financial market, you can only find liquidity at certain hubs that are very liquidly traded. If I'm at generator bus 1275 kV, I have a load zone that's far away, I probably can't find a Morgan Stanley or Goldman Sachs to issue me a swap for that congestion difference. I could go to the RTO and I could bid in the auction and then pay a certain price for that particular path. So that's very important, and it's a big difference in terms of participants in RTOs can actually hedge their basis risk perfectly. Virtual trading is a product, so RTO ISO markets have both a short-term forward day-ahead market and a real-time market. there's large differences between the actual prices in both markets. So there's a product available to actually hedge that. I'm almost done. Okay, so renewables. What do renewables in the US use usually to hedge? PPA is still the #1 way. Tolling agreements, not so much. We don't see a ton of activity in the futures and the swaps. I think because it's still a nascent market that, project finance and ensuring long-term sort of revenues is more important right now than hedging sort of spot exposure. We see more and more activity. Every month we see wind farms, especially, come in more and more in the futures markets. Financial transmission rights in the RTO are actively traded, and virtuals are traded because one of the big problems with wind farms in organized markets is non-performance in the real time. You have to buy back the power at the spot price if your forecast, if you overcommitted in the day ahead and then the wind dropped in the real time, you always have to buy back that difference, which is a large exposure to the spot price. In terms of marketplaces, ICE is the biggest marketplace with financial players in it as purely bilateral. Nodal exchange is the same thing, but it's nodal for RTO markets. And then there's more long-term futures on NYMEX. And then you have your bilateral market makers, which are usually large investment banks and some hedge funds. I won't have to talk about that. In terms of framework, so I work in enforcement. We deal with manipulation cases. A lot of them are at the intersection between financial markets and physical markets. Think about a boxer that bets against himself and then goes in the ring and loses. These future swaps can be much larger than the entire size of the grid or node traded underlying. So a company could go in and make a huge bet that the price at node A is going to go up tomorrow, and then go in node A and buy real power at really high prices. That happens a lot, and we're here to look for that. In terms of regulatory, FERC has jurisdiction on all physical power products and financial products in RTO ISOs. The CFTC has jurisdiction on the futures and swaps. And we coordinate a lot on cases, cross-market manipulation cases. By coordination, we mean we could either have joint investigations, or we could actually both investigate independently. So just because CFTC has jurisdiction over financial markets, it doesn't mean we can't use financial market behavior to make a case against a company using physical markets to benefit financial positions. So we're not constricted by sort of like, there's no death valley between the physical and financial markets. With that, I think that's all I had.